Hey everyone, welcome back to EconoFocus. I'm your host, and if you're new here, this is the channel where we take economic puzzles that sound simple and then, well, we make them complicated, but like complicated in a good way. The kind of complicated that actually helps you understand how the world works, rather than just giving you a satisfying but ultimately wrong answer. Today we're looking at something that gets talked about a lot in development economics circles, the mobile money revolution in Africa. And before anyone gets upset, yes, I know Africa is a continent with 54 countries and massive diversity, not a monolith. We're going to be focusing primarily on sub-Saharan Africa, and particularly on countries like Kenya, Ghana, and Tanzania, where mobile money adoption has been highest. So when I say Africa in this video, that's the shorthand I'm using, even though I know it's imperfect. If you've spent any time reading about development economics or financial technology, you've probably encountered this narrative. Africa is leapfrogging the West. While developed countries are stuck with their legacy banking systems, African countries are jumping straight to mobile-first financial services. It's the kind of story that feels good. The underdog using innovation to outpace the establishment. And there's definitely truth to it. But as with most economic stories that feel too neat, there's a lot more going on beneath the surface. So let's dig in. Here's something that sounds impossible. In Kenya in 2007, only 19% of adults had a bank account. Today, over 80% have access to mobile money services. The country leapfrogged the entire traditional banking system in less than 2 decades. That's the story we love to tell about African innovation, how mobile phones are democratizing finance, bringing millions of unbanked people into the modern economy, creating opportunities where none existed before. It's inspiring, it's revolutionary, it's the future of finance. But here's the thing. While mobile money has absolutely transformed access to financial services across sub-Saharan Africa, it's also created new forms of exclusion, reinforced existing power structures, and in some cases, made people more vulnerable than they were before. And that's complicated. So what's going on here? How did a continent with some of the world's lowest rates of traditional banking become a global leader in mobile finance? What does this actually mean for the people using these services? Is this the empowering revolution we think it is, or something more ambiguous? And finally, and this is the question that really matters, does this model of financial inclusion actually help people build wealth? Or does it just give them better access to staying poor? Let's start with how we got here. Because the story of mobile money in Africa isn't really about technology, it's about infrastructure, or more specifically, the lack of it. For most of the 20th century, traditional banking in Africa faced a brutal math problem. Building a bank branch costs hundreds of thousands of dollars. You need a physical location, security, staff, cash management, regulatory compliance. According to the World Bank, you need roughly 1,500 to 2,000 customers per branch just to break even. But when you're trying to serve rural populations spread across vast distances, where the average person might make $2 a day, that equation simply doesn't work. The customers you most need to reach are the least profitable to serve. So by the 1990s and early 2000s, you had this massive gap in financial access. The World Bank estimated that in 2011, about 80% of adults in sub-Saharan Africa were unbanked. They had no access to formal financial services whatsoever. And this wasn't just an inconvenience. It meant people couldn't safely save money, couldn't access credit, couldn't send remittances to family without risky informal channels, and were vulnerable to theft and loss. Mobile phones solved this by changing the infrastructure completely. Instead of building thousands of bank branches, Telecom companies just needed to build cell towers, which they were already doing to sell phone service. Instead of needing bank tellers, they used the existing network of small shops and kiosks that were already everywhere, selling airtime and supplies. These shops became agents who could handle deposits and withdrawals for a small commission. The genius of M-Pesa in Kenya, which launched in 2007 and became the model for mobile money across Africa, was recognizing that you didn't need to build a financial system from scratch. You just needed to repurpose existing infrastructure and make it work for money instead of just voice calls. And it worked spectacularly. By 2023, there were over 600 million registered mobile money accounts across sub-Saharan Africa. The total value of mobile money transactions in Africa exceeds $800 billion annually. In countries like Somalia and Zimbabwe, where traditional banking infrastructure nearly collapsed, mobile money became the de facto financial system. In Tanzania, mobile money penetration reached 65% of adults by 2020. In Uganda, the figure was 54%. These aren't just statistics. They represent millions of people who can now do things that were impossible before. A market vendor in Accra can receive payments electronically instead of carrying cash. A migrant worker in Johannesburg can send money home to rural Malawi instantly. A farmer in rural Tanzania can pay for supplies without traveling to the nearest town. This is real progress. But, and this is where things get interesting, having a mobile money account isn't the same as having financial inclusion. And this is where our story gets more complicated. Consider this. A 2021 study by researchers at MIT found that while mobile money dramatically increased access to transaction services, it didn't necessarily increase access to credit, savings products, or insurance, the things that actually help people build wealth and manage risk. You could send money to your mother in the next village, which was genuinely revolutionary, but you still couldn't get a small business loan. You could receive your salary electronically, but you weren't earning interest on it. You could make payments, but you weren't building a credit history that would let you access larger financial opportunities. What mobile money mostly provided was the ability to make payments and transfers, which is valuable. Before mobile money, if you lived in rural Zambia and needed to send money to family in the city, you might have to travel there yourself, taking 2 days and losing income from not working. Or you'd send cash with a bus driver and hope it arrived. Now you can do it instantly from your phone for a fraction of that cost. That's a real improvement in people's lives. But here's what's less often discussed. The companies operating these services, mostly telecom giants and their financial partners, are extracting significant value from some of the world's poorest communities. Transaction fees on mobile money services in Africa range from 1% to 10%, depending on the transaction type and amount. And while that might not sound like much for someone living on $2 a day, a 5% fee on every transaction adds up fast. A 2019 report from the GSM Association found that poor households in sub-Saharan Africa were spending between 2% to 7% of their income just on transaction fees. To put that in perspective, imagine if you made $50,000 a year and had to pay $3,500 annually just for the privilege of accessing and moving your own money. That's what we're talking about here. And these fees are often regressive. They take a larger percentage from smaller transactions, which means the poorest users pay proportionally more. And yes, I know what you're thinking. Isn't that still better than having no access to financial services at all? And the answer is, probably, but maybe not in the way we'd like to think. Let's break down what financial inclusion actually means, because this matters. True financial inclusion isn't just about being able to move money around. It's about having access to services that help you save, invest, borrow, and protect yourself from risk. It's about building assets. And by that measure, mobile money has been more successful at providing transaction services than at providing the deeper financial tools that actually change people's economic prospects. Think of it this way. Imagine three people. Person A has no access to financial services. They keep cash under their mattress. Person B has mobile money. They can send and receive money, make payments, and store small amounts digitally. Person C has a full-service bank account. They can do all of Person B's transactions. Plus, they earn interest on savings, can access affordable credit, have deposit insurance, and can build a financial history. Mobile money moved hundreds of millions of people from Person A to Person B, which is genuinely transformative. But it hasn't moved many people from Person B to Person C, and that gap matters. There's also the question of who controls these systems. Mobile money in Africa is dominated by telecom companies and a few large technology firms. In Kenya, M-Pesa is owned by Safaricom, which has a near-monopoly position with over 70% market share. In Ghana, MTN Mobile Money controls over 90% of the market. These companies aren't evil. They built something genuinely useful, but they are ultimately profit-maximizing corporations serving some of the world's most vulnerable populations. And monopoly positions in financial services are concerning anywhere, but they're especially concerning when the users have few alternatives. If you're a small business owner in Nairobi and all your customers pay via M-Pesa, you don't really have the option of not using M-Pesa. Even if the fees are high, you're locked in. What's worse is the data question. Mobile money services generate incredibly detailed information about people's financial behaviors. When they earn money, where they spend it, who they send it to, what they buy. This data is valuable, and the terms of service for most mobile money platforms give the companies broad rights to use it. For users in wealthy countries with robust privacy protections, that might be concerning. For users in countries with weaker regulations and sometimes authoritarian governments, it's potentially dangerous. Now, before you think I'm just being pessimistic about what is genuinely an impressive achievement, let me be clear. Mobile money has created real value. There's solid research showing positive impacts. A famous 2016 study by Tavneet Suri and William Jack found that access to M-Pesa in Kenya lifted 194,000 households, about 2% of Kenyan households, out of poverty, primarily by enabling women to move from farming into business. That's 194,000 families whose lives genuinely improved. Other studies have found that mobile money increases remittances, helps people smooth consumption during economic shocks, and enables women in particular to have more financial autonomy. A 2018 study in Tanzania found that mobile money access led to a 185% increase in women's business ownership. These are real, measurable improvements in people's lives. The question isn't whether mobile money is better than nothing. It clearly is. The question is whether we're conflating better than nothing with optimal or even good enough, and whether the narrative of technological leapfrogging lets us ignore more fundamental questions about economic structure. Because here's another way to think about this. Maybe Africa has more mobile phones than bank accounts, not because mobile phones are so much better, but because building proper financial infrastructure, the kind with regulatory oversight, deposit insurance, consumer protections, and affordable credit, is expensive and difficult. And it's easier to celebrate a technological workaround than to address the underlying problem. I already regret this comparison, but it's a bit like celebrating that people without access to clean water have figured out how to buy bottled water. Yes, bottled water is better than dying of thirst, but it's also more expensive in the long run, it's less regulated, And praising the innovation of bottled water distribution might let us avoid asking why there's no public water system in the first place. The best part, or maybe the worst part, is that some of the most sophisticated financial infrastructure on Earth is being built to serve people who make $2 a day, while wealthy countries struggle to make payments faster and cheaper. The innovation is happening where the need is greatest, which makes sense, but also where the ability to capture profits from vulnerable populations faces the least resistance. Let's address the elephant in the room. Is this critique just another example of dismissing African innovation or agency? Because there's definitely a pattern of Western observers either romanticizing African technological adoption or patronizingly explaining why it's not real development. And I'm conscious of potentially doing the latter here. The reality is that millions of Africans have chosen to use mobile money because it genuinely improves their lives compared to the alternatives available to them. That's real agency, and that's real value. And frankly, the developers and entrepreneurs who built these systems showed more creativity and insight into their users' needs than traditional banks ever did. But, and I think this is important, we can acknowledge both that something represents genuine improvement and that it's part of a larger system that's still fundamentally unequal. Both things can be true. Praising the innovation doesn't require us to ignore the extraction. Acknowledging the extraction doesn't require us to dismiss the innovation. There's a tendency in discussions about technology and development to treat innovation as a substitute for infrastructure. We see this with mobile money, but also with things like solar panels replacing electrical grids or apps replacing public services. And there's something seductive about this narrative. It suggests that we can solve poverty through clever market-based technological solutions rather than the hard, expensive work of building public infrastructure. But here's what that misses. Infrastructure isn't just about functionality. It's also about who owns it, who controls it, and what values are embedded in it. When Kenya builds M-Pesa instead of a public banking system, they get financial access, which is great, but they also get a system that's privately owned, profit-driven, and optimized for transaction fees rather than wealth building. Compare this to postal banking systems that existed in many countries during their development, including the United States, Britain, and Japan. These were public institutions that provided basic banking services at low cost, often at a loss, because the goal was broad financial inclusion rather than profit. I'm not saying postal banking would have worked in the 2000s Africa, but the choice between expensive traditional banking and private mobile money with high fees isn't really a choice at all. It's a failure of imagination about what kind of financial infrastructure is possible. It's worth noting that some countries are starting to recognize this. Rwanda has mandated interoperability between mobile money platforms. Ghana has introduced regulations capping transaction fees. Nigeria launched Naira, a central bank digital currency, partly to provide a public alternative to private mobile money. These are attempts to capture the benefits while addressing the limitations. So here's what we know. Mobile money solved a real problem for hundreds of millions of people. It's also created a new problem, a two-tier financial system where the world's poorest pay some of the highest fees to access the most basic services. Maybe the most honest thing we can say is that mobile money represents both genuine progress and the limits of what market-driven innovation can achieve when the goal is development rather than profit. Most of us alive today never had to choose between spending 5% of our income just to send money or having no safe way to do it at all. Hundreds of millions of Africans faced exactly that choice. They made the rational decision. But we should probably ask ourselves why those were the only two options. If you enjoyed this, hit the like button. It helps more than you'd think. Until then, stay curious, and remember, simple answers to complicated questions usually mean someone selling something. See you next time.